The most important macro trends are really inflation and interest rates. The fight against inflation is very far from over, and talks of a Fed pivot at this point in time are a bit premature, particularly with such a strong employment market in the United States. The other big driver of inflation has been energy prices, particularly if China begins to open up. If the Fed stamps out inflation by really crushing aggregate demand, then we're going to see higher unemployment, and conditions are going to be ripe to see a lot of fixed income instruments in client portfolios. If, on the other hand, we see more supply-side measures helping to ease inflation, then another set of investment solutions are probably going to be likely, and those may be quite focused on equities. In our view, it's very unlikely that inflation is going to be addressed through supply-side measures alone. So as interest rates go up, the companies that are going to be most exposed in the market are those companies that are not producing reliable profit streams. The only companies that can produce an economic return on the monies that they're raising from their debt operations are going to be creditworthy institutions that we want to invest in. And in this environment, we continue to believe that the value style will probably outperform growth with its greater focus on economic returns and cash flows. So in terms of risk considerations, first of all, there's a very good chance that the Fed are going to push the US economy into a hard recession. Investors need to remain very vigilant to that potential outcome. Secondly, if China begins to open up, that could put more upward pressure on energy prices, which may prolong the Fed's and other central banks' battle against inflation. I think this is a very dangerous time to significantly underweight Chinese assets. China has a very diverse equity market, and there are lots of opportunities for investors, particularly in sectors that are favored by government policy, such as green tech, EVs, battery technology, solar panels, and increasingly the semiconductor industry. China's been through a very difficult period of time. We're past the worst point in terms of impact for investors. Valuations and earnings expectations are really at very, very low levels. So the upside is very significant. This is also true for fixed income. Again, one of the largest fixed income markets in the world, and one where investors are very, very significantly underweight. I think that ESG is very much entrenched in the investment agenda. At the same time, the approach to ESG is becoming more balanced. It's moving away from an approach which is largely driven by exclusions to one which is much more about engagement with companies that are big CO2 emitters or big polluters. And that's a change that we very much welcome, and we've been gearing up over the past year or two to really redouble on our engagement efforts. I think portfolio resilience is going to be very important over the coming 12, 18 months. We're moving from one regime where inflation is a key driver of the global economy, and the Fed is fighting very hard to get that inflation under control, into a much more uncertain environment. Therefore, we need to build a lot of diversification into portfolios to cope with this type of uncertainty. Volatility is also likely to remain very elevated. Again, we need to fight that through diversification, but also through the use of techniques and strategies such as low volatility investing, which will help to significantly reduce the overall levels of portfolio volatility.